Massive deficit spending, bond yields increasing globally. How is this going to affect commercial real estate? Stay tuned. Hey guys, Josh and Aaron back for another Finance Friday, and in today's video we're going to nerd out a little bit and talk about something that is super important but really isn't understood by the majority of the population, which is bond yields. Now, for anybody who doesn't love finance like us, bond yields are basically the base layer of money. Like, a bond is something that a government issues to be able to provide a guaranteed rate, and the majority of people, like average consumers, don't actually buy bonds. Bonds are like a financial instrument mostly used institutionally to provide guaranteed yields. A lot of the times certain types of debt are backed on bonds, but the majority of the time the base layer of guaranteed returns are based off of government bonds. Now, there's a handful of type of different government bonds. There's BoC, which is a Government of Canada bond. There's CMB, which is a Canadian mortgage bond. There are Fed notes, which are long-term United States bonds, and they have different denominations and time frames. So some can be short-term bonds, which can be like 30 days. Some can be long-term bonds, which can be 5 years, 10 years, 20 years, 30 years, and those essentially guarantee returns on investment backed by the government entity that is providing the loan. So if you're like a fund manager and whatnot, and you're looking for a certain portion of your fund to be guaranteed, you would own some bonds to diversify risk and make sure there isn't any movement. But in our case, bonds are specifically used to determine the cost of debt, and that base layer of bond issuance or cost has a lot to do with fixed rate mortgages, the cost of your mortgage at home if you have a fixed rate mortgage, but it also has a lot to do with commercial mortgages, cap rates, yields, movement in the market. Really, bonds are, the cost of bonds dictate the movement and flow of money in our society. So a lot has been happening in the market lately that we thought we should make a video and let you guys know what's happening, how it's going to affect you, what we think it's going to do to the real estate market, and maybe how you can be prepared long term.
Yeah, beyond the bond and how it's used as a financial instrument, it's also a really great indicator to how your economy is doing and what the forward long-term thinking or projections of the economy are. And you can see that evidence just by watching the bond markets and paying attention to the news and what's being said, specifically, I guess, for Canada, more so U.S. trade talks and policy conversations. But it's interesting when we start to pay attention to it, and maybe an experiment at home. Pay attention to any time Trump gets on Twitter or gets into like a feud with Elon, and go online to figure out where Canada's CMB is at or BoC, and then watch what happens, over the next few days. And you can really start to kind of predict when you're going to hear something that's, going to cause bonds to go up or bonds to go down, just based on the trade conversation and what that means. So it's both a financial tool, but it's also a great indicator of how things are going in the country and, where a lot of the economists are predicting for the future.
Yeah, what's really important to understand is that bonds are forward-looking. So bond traders dictate the value of the yield or like what they're going to pay based off of forward-looking guidance. So for example, if the bond traders are expecting the Bank of Canada to pause rates and they don't pause, and then they pause rates, you're not going to see a bunch of variance in bonds because they've already priced in tomorrow's guidance that they expect. But what happens is when you see major changes in bond yields, it's because something unexpected has happened that changes the outlook, economic outlook of something. So, if most people, bond traders, decide that we're supposed to pause rates, but they cut rates, that would have a direct cut on bonds because it was something that was out of the realm of what most traders had decided was going to happen. So just remember that they're always looking at tomorrow's price today, and that's how they price out bonds. So what's happening right now? So a lot is happening right now. The world. So historically, bond yields are pretty stagnant. They're pretty level.
Typically your safest instrument that you can safer instrument you can invest in long term. But yeah.
Very rarely do you see massive variances in bond yields, and unfortunately since COVID, that hasn't really been the case. We've seen huge variances in bond yield pricing due to economic uncertainty, and right now we're in kind of the same situation where we have tariff wars, we have global geopolitical issues, challenges. The economy is, I wouldn't say teetering, but the R word is being thrown around quite a bit. Stock market is basically standing on pins and needles and moves record levels every single time something serious happens, and then it bounces right back. So bonds right now are very susceptible to any sort of news movement in the market, and what we're seeing is massive variances in these yields daily, and very rarely do you see 10 basis point, 15 basis point increases, but this is what's happening right now. And if you're in the multifamily space, it's important because it's how your debt is actually priced. So, what we want to do is kind of dig into what you can expect with higher bond yields and what that means for, your development today.
Like Josh said, when we're taking like the commercial side, everything's based pretty much on the bonds. You don't really get into too much of variable tight debt. That's going to be based on your prime and your Bank of Canada overnight rates. Everything is forward looking, which is good and bad, I guess, depending on how you're looking at it. Obviously, with the volatility of bonds, there's a lot of uncertainty until you get up to rate lock or actually closing on your transaction, depending on whether or not you're using CMHC, where you're gonna have a rate lock period, or whether you're just going with a standard commercial lender. You're not gonna have a rate lock, but you are gonna get a quoted interest rate up front. Obviously, if there's huge volatility, the lender may have to come back to you and request some sort of movement in the rate. So up front, there is a lot of volatility, which just means that you need to pay attention to what's going on. And if you're getting into CMHC debt, depending on where your ceiling rate is being submitted at, and just to explain that further, the ceiling rate is basically where we stress test your deal at. So if you're looking to borrow $10 million in today's market, we would probably stress that around like 3.9 or 4%, and that just means that you're good at qualifying on your debt up into a bond rate with your premium up into 4%. Anything above that 4%, either you hope the rate comes back down in time before your rate lock, or you're going to have to inject a buy down into the transaction. Or worst case, if you didn't want to do that, you could go back to CMHC and request them to reduce the loan, but 9 times out of 10, it's actually better to go ahead with the buy down. You do get more money back overall instead of reducing the loan. Now, on the positive side with bonds, when you're getting into the CMHC side, once you've locked that debt in, you're locked in. You're not dealing with the variable price fluctuations that you may be dealing with on some of these residential loans. It is locked in, which means you can get a great rate on a property, CMHC debt for 10 years. That building is locked in, it's set, what your cash flow is going to be for the foreseeable future. You don't have to worry about it. It's going to be able to give you a pretty solid, concrete, predictable cash flow model, especially if you have shareholders, guys that you're looking at doing like cash dividend payments, stuff like that. You're going to be able to have easy predictions down the road. That being said, when we take a look at the 5-year CMB specifically, you do get the same stability of cash flow throughout that 5-year period, but because it is a shorter bond, it does leave you open to potential price changes come maturity. So if you're taking a look at larger debt, 10, 20, 30 million plus in debt size, and you're doing a really high leverage loan, 90, 95%, you're probably better off taking a 10-year bond, even though the bond basis points are a little bit higher, just because at the end of that 5-year, you do have potentially run into some issues with your ability to renew depending on where rates are at that time.
That's a great point, because a lot of debt was issued back in 2020, 2021. For people who don't follow, there were rates at 1.5%, 2%, and with today's rising bond yields and semi-flat to reducing rents over the last year or so, it does pose a risk for all these people who took 5-year debt at very, very low interest rates, who are now renewing into much higher, maybe double, triple the cost of the debt they're looking to take on, and they had semi-okay rental growth. It does pose a challenge when you're looking at coming to renewal, and you took a short term and the interest rates have tripled in size. So what we do is we're looking at that on renewal as a challenge that some people are going to have to deal with. Like rental growth over 2021 to now has significantly increased, so hopefully the NOI on the building is enough to be able to support the debt payments that are significantly higher than what you were at previously. But if you had a bunch of turnover and you haven't necessarily had the rental increases that you need, this could pose a serious problem on renewal.
I think the next piece to understand is just how lenders are pricing your CMHC debt. So again, CMHC CMHC-insured debt, we are basing it off the CMB, which is the Canada Mortgage Bond. You're going to have two components of this. There's going to be your base bond on your 5 and your 10 year, and then there's going to be the premium that the lender is going to add on top of that, depending on the size and the type of file that you're dealing with. You're always going to have somewhat of an understanding of where your base bonds are at. You can easily just go online. Most lenders' websites, our websites have where the bonds are at daily and any sort of changes. It's the premium that's for the most part unknown. The premiums really depend on the loan size. The larger the loan size, probably starting at 10 million and above, is when you're really going to start to get your best pricing. Under that 10 million, it's going to depend on the lender and where they're pricing it at. Anything under 5 million for sure, especially when you start to get into these $1 million, $2 million, or even sub $1 million loan sizes, that's when you're really going to get your highest premiums on top of that. And it's also why you hear a lot of people in the CMHC space talk about lenders not wanting to lend in certain area. When you understand CMB and the allocation, it's not unlimited. There's not an unlimited amount of allocation that's available. There is a finite amount. The bigger lenders, the First Nats, MCAPs, KingSets, CMLS, these guys, they don't want to kind of allocate that capital in the smaller deals when they're dealing with bigger REITs, institutional lenders that need that capital. So that's why the smaller stuff, either the lenders aren't going to lend on it or they're just going to price it super high. Your bonds in the bond premium, for anything over 10 million, you're probably looking at, on a 5-year debt piece, you could be starting at 5-year plus 85. I just had that on a $10 million deal. On the 5-year was 5-year plus 85. Your 10-year, the premium is a little bit lower, even though the base bond is a little bit higher. So, when you're 85 bips on the 5-year, you could be 60, 65 bips on top of the 10-year. The reason why the 5-year is priced so much higher is two reasons. One, everyone wants a 5-year piece. They like the flexibility that comes with it. They like the fact that the base bond is lower, so therefore your overall rate is probably going to be lower than on a 10-year. The second reason is also because CMHC came out and they split out the allocation of the 5-year bond. So you now have half of that being allocated to your single family res CMHC deals, and then the additional half is being allocated to your multifamily 5 and up insured debt, which means there's just not that much allocation left over at the end of the day. Another factor that can dictate your pricing is where are we at in the year and how much allocation is left. If a lender has a lot of 5-year allocation left, then maybe they're pricing it to move, because if they don't use it, they may not get that same amount of allocation at the end, going into next year. So it might be cheaper. On the other hand, if a lender doesn't have a lot of 5-year debt left, they may even push you into a 10-year depending on the size of the file, or you're just going to get a really high premium on top of that 5-year debt. Again, you don't typically run into issues on the 10 years, so you don't have that same premium pricing, but on the 5-year for sure, depending on where you're at in the year, even can dictate your pricing.
Yeah, and it's challenging because you don't, as a consumer, you would never know this lender has specific allocation at this time for this. Working with a broker allows us to be able to keep a finger on the pulse of maybe certain lenders that have certain allocation, because as Aaron said, they split it between res and commercial, and sometimes depending on the year, like right now, not a lot of people are using not a lot of lenders are using residential insured allocation. So a lot of it's being pushed to the commercial allocation. But at some point, the market's going to pick back up from an affordability or price standpoint, and there are talks that there won't be enough allocation to deal with the demand that's currently that we currently have, whether it's in renewals. And keep in mind, the annual allocation that they have, it's also for the renewals coming up on the book. So you take a look at volume that has happened over the last 5 years. There are certain years that have massive amounts of 5 and 10-year debt that are renewing. So, not all lenders, some lenders, some very large lenders are passing the renewal book to, other lenders that have more appetite for smaller renewals. There's a lot of puzzle pieces that go on when you're looking at, taking on or pricing the CMHC debt. For all of our developers out there who are in the middle of a project or are getting ready for a project, it's important to understand how these bond deals are going to affect your project. Even though maybe you're in private MIC construction capital or conventional capital, and you are maybe 12 months or 18 months out from getting your CMHC loan, it's important to understand that the bond deals that start to creep up when you're at the start of your project or the end of your project, you need to continue to underwrite and adjust your max rate on submission to be able to kind of align your equity at the end of the project. Because if you're in the middle of a project with a CMHC lender, for example, and you start to have huge increases in bond yields, it is possible that the lender will require that you have an equity injection to make up the difference, because essentially what they're doing is they're underwriting the takeout financing at the end of the project. And if you're up a whole basis point, that requires more equity on your end to be left in the deal. So they might require it up front. We saw this happen during COVID when we had massive price movements with the overnight lending rate. And this could happen now. So setting realistic expectations, and as a good developer watching the bond yields and seeing where they're at, just to kind of set a precedent here, we are in the first week of June, and from 6 months ago, the CMB is probably up, 80 basis points, 90 basis points from where we were at 6 months ago, which is the difference between deals not working and deals working. So when you're looking at becoming like an expert in this development space, it's important to understand that the bonds, which you have no control over, have a lot of power over how the numbers are going to kind of fizzle out at the end of your project. So keep an eye on the bond yields.
If you guys haven't already switched over to ChatGPT to get a more easier and fluid understanding of bonds, we'll continue to kind of talk about some of the things we see with CMHC here. So one of them just being early rate lock. So if you're following the bonds and you have a closing that's a week out and you saw a huge surge in the bonds, you do have the opportunity to try to lock your rate in early. Obviously there is pros and cons to this. Obviously, pro, you save yourself some money from potentially having to have any and or a larger buy down if the bonds were to continue to rise. The con is, sometimes it's hard to time the market. And, sometimes there's a piece of news that comes out and the bonds shoot up, but then there's a follow-up story and the bonds come back down, a few days later. Obviously, this is really going to depend on your comfortability. Where's your ceiling at, right? So where the deal get stress test at with the bond rates, how much equity do you have, capital to be able to put towards a buy down, and just your financial economic knowledge and your belief, right? So if you do get into the rate lock and you decide I don't trust where their bonds are going, I want to rate lock early, great. There are a couple things to understand. That rate lock is technically only good for so long. If you do miss your funding date or you don't fund on time for whatever reason, to be able to continue beyond past that date, there is hedge costs that do happen. So usually it's about 2 basis points every 7 days. So just keep that in mind. There is a cost to locking in your rate outside of the potential buy down.
Yeah, absolutely. Last but not least, I think one of the most important things you guys should really know, and what sometimes comes as a surprise to borrowers, is what the buy down actually is going to cost. And buy down is something that it's important to understand that as brokers, we can sit here and we try to strategize with all of our clients about submitting at a max rate and then understanding what buy down looks like. But it's important to understand we don't have a crystal ball. We don't know what the bonds are going to look like in 4 months from now when you're locking in your rate. But what we do know is what our submission rate is or what a max rate is, and what the risks could happen or could be involved if you do have higher bond yields. So usually what we try to do with most of our clients is submit at the highest rate possible to maximize your loan to cost, loan to value option with the program that you're looking to take on. Most people try to maximize the product because they're paying the insurance premium to do it, so they're accessing the equity. Now, what happens is most of the time, especially in an inclining interest rate environment, we have to submit at the lowest rate possible to be able to get that highest loan amount. Well, when you have interest rates rise and you start to have a differential between what you lock in your rate at versus what we submit the file at. Let's say, for example, we submit a file at 3.75%, but we go to closing and the bond yields have gone up and now you're locking in your rate with your premium at 4.75%. You have a 1% delta or difference between what you submitted the file at and what the locked in rate was. Now, you have to pay that difference. Now, that difference, if you're refinancing, can come from your equity takeout. So it comes from the proceeds that were supposed to go in your pocket. You have to pay the difference throughout the term of the loan. So on a 5-year, it's not as bad depending on the difference. On a 10-year, it can be quite significant because you're paying the difference over a decade long. So it can be quite a shock. Usually what we do is we try to take a look at what makes sense from a bond rate perspective when we're actually submitting the loan, and we have a conversation with the clients about expectation on buy downs. It's important to understand that buy down is also discounted. It's not dollar for dollar. It usually always makes sense if you're looking to maximize your loan amount to submit at the lowest max rate required to submit the file, because dollar for dollar you're not paying the full dollar. You're paying about 70 cents on the dollar to buy down the rate, so you always get more cash in your pocket net than you would if you submitted at higher max rate and a lower total loan amount. as a whole. All right, guys, we know that was pretty heavy and that was a lot to absorb. So if you did make it to the end of this video, congrats to the two of you who did. We appreciate you both. If you have more questions about the video and specifics around your situation as a whole, or bonds and how they're going to affect your project, please reach out to Ehren. We'd love to sit down and nerd out and have a conversation with you about this stuff. If you like this video, you got some value from this video, hit the subscribe button, hit the like button. It allows us to continue to make more content for you guys. I really appreciate you taking the time today. We'll chat soon.